Okay, welcome back to day one of the Compliance Forum, everybody. My name is Kavita Maharaj. I'll introduce you to this panel of esteemed guests, these very exciting-looking people, in a second. But introducing this session now, as you can see, the name of this session, How to Safely Bank Low-Risk Clients in High-Risk Jurisdictions. And then we ask the question, is it now the time to re-risk? So, as you all know, banks are facing that difficult balancing act when it comes to banking legitimate customers in high-risk jurisdictions. The cost of the additional due diligence is a concern. The risk of compliance missteps, also a huge concern. And that, especially when you balance that against the relatively modest financial returns that those relationships can often deliver. So the questions we want to try to answer in this particular session is, what can banks actually do to avoid fines, but at the same time avoid financial exclusion? And are there global or even community-driven strategies that can benefit everybody? And how does the shifting sanctions landscape, with restrictions being relaxed for some countries, I think of Iran immediately, change the compliance dynamic? So joining us to discuss all of these issues are these exciting people. Let's start with right here on my left, John Cusack. He is the Global Head of Financial Crime Compliance at Standard Chartered. Next to him is Julie Katzman. She is the Executive Vice President and COO of the Inter-American Development Bank. Next to her is Richard Lalonde. He is a Senior Financial Sector Expert at the IMF. And last but certainly not least, Jochen Metzer. He is the Director General of Payments and Settlement Systems at the Bundesbank. So thanks all of you for being with us, and thanks to you for being with us. So I want to kick off with you, Richard, first of all. The IMF is obviously seeing the effects of de-risking at a very macro level, aren't they? Tell us about some of the things that you're seeing.
Thanks, Kavita. Yes, we have been seeing a number of things. Obviously, our members have been talking to us about the issue in the context of our annual discussions with them, what we call surveillance. And what we've seen and looked at is that the number of correspondent banking relationships has decreased over the past few years, and it decreased significantly, I would say, from 2014, 2015. And we've seen the effects of this in a number of regions, a number of parts of the globe, particularly in the Caribbean, where we've had more than a dozen Caribbean local banks have their relationships severed with global banks. We've also seen it in some of the small South Pacific islands as well, but as well in Africa and in the MENA region, the Middle East and North Africa region as well. So we've seen these relationships dropped in these particular areas. But not all is doom and gloom. And in some way, there has been some pickup. Obviously, what we have seen as well is not only have the number of relationships gone down, but the absolute or the amount of the correspondent bank payments has actually gone up. So we figure that that financial institutions in a number of regions have been finding alternatives as well. So at a global level, to answer your first question, are we seeing a macroeconomic impact? No, we're not seeing it at this point in time. But we're certainly concerned about the effects it can have on some of our members, though, and individual members, that is. Thank you. Okay.
And Jochen, you obviously sit at the Bundesbank, but you also are the chair of the CPMI, Global Working Group on Correspondent Banking. You work also with the work streams for the Financial Stability Board's contact group. Tell us what you're seeing from your side.
I can mostly confirm the picture Richard has been drawing. It's a tendency towards concentration of correspondent banking relationships, and it's uneven across jurisdictions and regions. If you look at North America, Western Europe, Asia, you don't see anything, you hardly see anything. But this, let's say, iron triangle of correspondent banking is masking the development in smaller jurisdictions and in other regions. Therefore, I very much concur with the analysis of Richard. This is what we find. There is danger for some countries to be cut off the global payment network. And of course, this is a matter of concern.
Mm-hmm. And Julie, sitting from the Caribbean, one of the most affected areas, and LATAM at the Inter-American Development Bank, what's your view?
So first, I would say from our perspective, the fact that, and I would guess most of the people in the room here, fighting money laundering and terrorism financing, those are good things. Mm-hmm. And we think that better supervision and strengthening financial systems as a whole are positive things for development. But before I talk about the region as a whole, I would say, one of the things that you hear about here, though, is that word, de-risking. Mm-hmm. Risk implies that you do some sort of assessment to decide if something is risky. And yet, what we see here is that banks are de-risking their relationships even before evaluations are done. And so that, to us, implies that there is also something else going on here. And I think that also plays into the fact that the word risk implies taking some, perhaps. It's an educated guess or assessment of not everything is going to work out. And here, again, we seem to have developed kind of a zero tolerance on that risk spectrum. And I think that part of that is going on because people are operating in an environment where they're not quite sure what the regulators are going to do. And that creates fear. And when you create policy out of fear, you tend not to optimize. So in addition to the Caribbean, we see this in Central America as well, and other small countries in the region. And while the IMF, looks at all this from the macro perspective, you can look at individual countries, and I'll use Belize as an example. Belize has suffered de-risking in a very substantial way, and importers and exporters are without doubt, there's an increase in their costs associated with that, which then trickles down to the population. We talked about other countries in the Caribbean where, as a result of certain businesses no longer being able to provide foreign exchange, you have large groups of the population who earn most of their income from tips from tourists, and now they can't really exchange them back. Mm-hmm. And I'll use another example, which is in Haiti. What you've seen is most of the financial institutions having lost their relationships. And that worries us because we see kind of a race to the bottom with some of the other financial institutions. So, I think when you look at the individual economies, you do see this phenomenon, and I think we'll talk about some unintended consequences later.
Yeah, absolutely. Before that, let's get John's view, and I hope, John, you're not one of the banks that have not done this risk assessment that Julie was talking about.
It's not the bank's fault again. If I can pick up, actually, on something Julie said, it's my sense that actually the pace of de-risking is slowing. Mm-hmm. My sense of it. I think the information that's out there showed that we peaked. However, and this is of major concern, whilst I think the pace of de-risking across various jurisdictions has slowed, the number of remaining banks in certain markets that are willing to pick up correspondent relationships is probably fewer than there's ever been. So the challenge now is to not make that worse, and actually understand we're still at a very critical position. So I think that's really, really important. As far as we are concerned, how do we actually manage in this difficult area? I think the banks themselves, I think we do three things. I think the first thing is we have to understand what the regulations are. And they've changed a lot. I've been doing this for many, many years. And actually, if you look back 10 years, look back 5 years, look back to where we are now, the expectations on us as to what we need to do for ourselves and also vis-a-vis our correspondents has just increased tremendously. Yeah. And it is not absolutely 100% clear what that standard is. Yeah. And those expectations evolve, and that actually makes it quite challenging. I think secondly, it's not just about the correspondent, it's about us. We have not lived up to the standards set, right? And we have to improve, and the major clearers have really invested, I think, a lot to get to a much better place. We ourselves aren't where we want to be yet, but we are certainly significantly improved. Once the big banks, the clearers, get to a better place, I think they are more likely will be in a better position to take and to manage that risk much better. And then, of course, the third part of that is our correspondents also need to collaborate with us and move along that journey with us, not having the same standards inevitably as us or investing the same, but certainly continuing that journey to actually improve controls in country.
You mentioned standards, and I don't know which one of you wants to take this first, but which are high-risk jurisdictions and which are low-risk clients in a high-risk jurisdiction? It seems to be different things for different banks. Who wants to go first? Okay, Richard.
Okay, Richard. You start.
Just very briefly, I mean, the standard setter for anti-money laundering, of course, is the Financial Action Task Force. One of the things that it has done most recently is change the standard, is revise the standard to make it more, or integrate more the risk concept into the basic standards. So it does call upon countries, it does call upon financial institutions and others to implement, more than that, to identify their risks, to assess them, and then to understand those risks, in then charting a way to mitigating them. So the international standard setter in this particular area, the Financial Action Task Force, has left it essentially to countries and to financial institutions to assess their risks and to behave accordingly. Now, that's not saying that the Financial Action Task Force does that. It also does this white list, black list, gray list type exercise. But quite frankly, I mean, the number of countries that are on that particular list may be the starting point for financial institutions to in order to chart their way through. But on the other hand, it doesn't take away from the obligation, from the good sense of assessing their own risk in the first place. After all, in some countries that are deemed to be risky by the Financial Action Task Force may have some ultimately very good customers for financial institutions globally. So I think this is where we are.
I would be pragmatic and start with the lists. And I look at the white list and at the black list of the FATF when it comes to anti-money laundering. And I look at the OFAC sanctions list and the UN sanctions list and the EU sanctions list. And to give you a practical case, let's take Iran. Iran is on the FATF blacklist. So it's a problem from an anti-money laundering CFT type of view. However, some of the sanctions, the nuclear sanctions, have been lifted. So what are you supposed to do with such a country? Well, I guess this is then where individual analysis and your judgment is called for. And this is, let's say, where we want to put a little bit of pressure on John. Let's say how he does it, and we hope he does it profoundly and he does it well.
You want to come back?
I hope so too, Joachim. The interesting thing is FATF actually say that all foreign correspondents are high risk. Doesn't matter which jurisdiction you come from, whether that's the wonderful country of Germany, which is generally low risk for most other things. Yeah. If you have a US dollar account for a German bank cross-border, then you're high risk. So the question isn't who's a high risk and who's a high risk jurisdiction. Everyone is high, which is a problem in itself. But then we have gradations of high between high, Germany, and very, very high, Iran. So we've got into that. But country risk used to be pretty much the single most important factor when we judge banks 5-10 years ago. It's probably 80-90% of it. It's now not. It's 20-30%. And lots of other factors come in which we take into consideration, being the customer risk, the kinds of business that it does with us, the kinds of behaviors, the values, the volumes. So it's much more an aggregated risk profile. So you can get a very different approach for a very strong bank in a high-risk jurisdiction versus not so strong bank in a high-risk jurisdiction, which I think is the right way. Yeah. And it goes to Richard's point about the risk-based approach.
Julie?
Yeah, these guys manage this part of things much more than I do. I think that what John just said is exactly right. I mean, you have to use judgment to make gradations between. There are jurisdictions that are known for problems. We spend a lot of time working with those jurisdictions to try to help them improve.
Is there a feeling, both Julie and Richard, that banks are doing this? Obviously, they're under the gun from regulation. Margins aren't as great as they used to be. I mean, I went to the London School of Economics, and that was in the early 90s, and everybody, your choice was do not, stop at wherever and go directly to investment bank. Of course, everybody I speak to, the other day I was there giving a talk, and nobody wants to go into banking at the moment because you don't make any money, they say, in banking at the moment. Is there the feeling that banks are doing this because they're reassessing their business models and are pulling out because these are profit-driven decisions and not necessarily a risk issue?
Well, I think we think that that's partially the case. Depends on the bank, depends on the... But, this was probably never a high-margin business, right? And in a low-interest rate environment, this is a lower and lower margin business. And all of the environment around regulation around it makes it a much more, let's say, risky business internally. And so what's the risk and what's the return? So if you have this phenomenon happening around you, you might just use that as an opportunity to get out of a lost leader, so to speak.
Richard?
No, I absolutely agree with what she has said, and more so. I mean, there are a number of drivers to this phenomenon, and they all are acting concurrently. So we do have financial institutions that are reevaluating their business models. Some want to go more local, less cross-border. Each bank will have its own strategy and the way they want to move it along. But there are also a lot more requirements today than there were, say, back in the 90s, so that they have to take into concern and take into account, such as, you've got tax issues, you've got AML, you've got international sanctions, et cetera, that weren't there a number of years ago. And finally, you've had a large number of these what I would call eye-watering sanctions or compliance fines that have occurred over the last few years, which would surely put any boardroom in a tizzy, I would imagine, questioning why we are doing business where we are doing business.
John, Standard Chartered, you're not in a tizzy, are you?
Not anymore, not as much as we were. Interesting you mentioned the LSE, of course, who famously banked the Libyans, but didn't receive a fine for that, if I remember. On this subject, I don't think de-risking per se is a problem. I mean, banks should be able to go in and out of markets, the commercial organizations. The problem is that actually with efficient markets, there should be plenty of other people wanting to actually provide the service. So there should be plenty of people in the Caribbean, if other people go, that can support banks in the Caribbean. The problem is that people don't want to come back in because either the costs are too great or the risks are too great, I think. And so I think it isn't just around profitability. I think that's a perfectly legitimate thing for banks to do. The problem now is there isn't sufficient capacity in those key markets. And it's difficult to criticize financial institutions, and obviously this is self-serving, but they're entitled to make profits and they're entitled to do business where they want to do. But, of course, there's this consequence, and we have to make sure that consequence doesn't realize, because it has real impacts in real people's lives.
And I think part of this is why is it not profitable enough? So there's one part of it which it's cash on cash, not profitable enough. The other is it's not profitable enough because I have the specter of concern of what could happen to me. And I think that's the part of this that is more worrisome. Because you have financial institutions acting all pretty much at the same time, in the same direction, because they're worried about what regulators will do. And they can't quantify that, right? And so that, to me, is the scarier part, because I agree with you that absolutely, if it's not profitable, every bank makes its own decision. And I actually had a conversation with the governor of one of the central banks in the Caribbean to talk about, has any bank offered to pay more in order to keep its relationship? And the answer was yes. And in one case, it worked.
Yeah.
Right.
Jochen?
Yeah, I think we should also look at the efficiency and safety of due diligence processes. Maybe the business case is negative, because those processes are not as good as they could be. And as central banks, as overseers, we are worried in this direction, and this is the reason why we issued 5 recommendations in our report that try to go a long way towards, let's say, more efficient, better due diligence processes, thereby improving the business case and thereby also reducing the risk that any given regulator would find your process wrong and therefore would be willing to dish out a hefty fine to you.
Do you want to elaborate on some of those points in that report?
Yeah, say some of those points, they go towards the information that you need in order to be able to provide you diligence, enhanced due diligence to really drill down. And of course, you have to get organized on this information. A KYC, a Know Your Customer utility, might be a good point of departure. And of course, you have to put the information in and you have to sort it out and think of the legal identity identifier. If you have this for the beneficiary and the ordering party, then let's say you can start automating what you're doing. And this probably, let's say, could help. And once you have the machine in place, whether you do 1 or 10,000, doesn't matter so much. However, it matters when it comes to cost.
Richard?
Yeah, but I think what Jochen has said is correct. And I think industry does have its own part to play. And these KYC utilities can perform a useful function. But they are not... If we're looking for trying to address the myriad of drivers that are driving this issue, you also have to look at, and I think Julie brought it out quite clearly, is regulatory expectations. And one of the things that has not been clear are regulatory expectations on the part of the major supervisors across the globe. And I think greater in individual cases where a country, where its financial institutions have been adversely affected by the loss of correspondent banking relationships, I think one of the things that has got to take place and has taken place in a number of successful occasions is dialogue between the supervisors, between the regulators themselves. In both jurisdictions, and absent that, then you're not really going to find some alternative solution to this issue.
I just want to get to some of the comments people have been sending in. A few that I think be interesting for you to come back on. All of you, the panel needs to consider that 80% of due diligence costs are fixed. De-risking, is it creating a greater insecurity as it creates ungoverned financial spaces and drives money flows underground? So those are some of the unintended consequences. And as a bank, do we care? As a banking community, do we even are we even bothered about that at the moment? What should governments do to reverse bank de-risking decisions? Who wants to come back on what first?
I'll take some of the unintended consequences, right? So remittances is a business that has been heavily affected by this. And the most recent data that's very reliable is 2014. $400 billion went in remittances to developing countries through the formal financial system in 2014. And $130 billion went through the unofficial, informal means. And to put that in perspective, that's 3 times the level of development flows to the developing world. So we're talking about elements that can be over 1/3 of Nepal's budget to 20% of many countries' overall GDP. And when you can't get money to Somalia through any financial institution, it does go underground. And we're seeing some of this within the Caribbean as well. So it drives the money out of the formal financial institutions, which is not really what we want to see. We want to see more transparency and be able to track money. And secondly, the people who end up suffering in that regard are the least able to, the most vulnerable. And you put international organizations into a very funny position. Again, with this lack of certainty around the regulators, there are safe harbors for, let's say, the UN to work in North Korea, where they're trying to provide food for children. I'm watching John's head, right. But no financial institution in their right mind, given the situation that they're in right now, will take care of that, right? So what does that leave any, not-for-profit or the UN itself or others to do? So, I think that there are these unintended consequences that when people were thinking about the good, money laundering, terrorism financing, they weren't thinking about the what might happen piece.
But the solution is out there. We have to work together, industry and government together, to solve this problem. Principal issue is this gap between actuality and regulatory expectations that moves. And it's not the regulator's fault per se. That's just life. That's life in our world.
Yeah.
We learn things, new things. We do extra pieces. But I do think we need to close that gap and work together. We are actually doing that. We are coming together. We talk to regulators. They understand the nature of this risk. They understand the consequences of this. And there is certainly a greater than ever willingness to actually try and address this. And so amongst the banks, absolutely, there's really an open conversation that's currently ongoing with the main regulator to see if we can fix this. But I think that's the particular piece. To Jochen's work that he's done, which is really fabulous, I think a lot of his recommendations we all support. They probably tackle 20% of the problem. They probably don't tackle the last one. One of his recommendations around standardization or around agreeing what the standard of due diligence ought to be is the critical piece, though. And that's not easy, but that's really what we are working on.
We are definitely willing to improve on the 20%, John, because two of our recommendations, they are not, let's say, directed towards banks or other standard setters. They are rather directed towards authorities, namely the FATF and the Basel Committee Anti-Money Laundering Experts Group. And we have detected some willingness to engage. So we will most likely see, let's say, a fruitful discussion with John, with the industry, with Wolfsberg and the Payment Policy Practice Group. We will see that, let's say, as the banks raise their game, as they get better in due diligence, the regulators will need to be more precise about their expectations. So I have hope that the gap can be closed. It may not be closed entirely, but we should go well beyond the 20%. Okay. We should be better than half, John. That's my expectation.
Thanks.
Before moving on, maybe I would be remiss if I didn't mention this, and this may not be politically correct, but there are countries around this globe that don't implement international standards in a correct manner, or they fall short. And certainly, although this is not a short-term solution, but countries should be that are affected by this particular issue should be looking at their own systems in place in a clear and frank way, and not just claim that yes, we do implement international standards. The reality is much different when you get on the ground, and they are best placed to be able to do that kind of work.
And Richard, some of the countries that you're talking about, what would be some of the biggest things that they need to address first, would you say?
Well, they need to address their KYC requirements. They need to address their what we would call the identification of beneficial ownership requirements. That is a big, big issue, not only for developed countries, but for developing countries as well.
So, I would just say in the answer to another part of this, which was what should countries do, right? Mexico is a really interesting case, right? Because obviously huge trade partner with the United States saw this happening to their banks and could not just stand back and really took what I would say is a holistic approach to this, and that's a big part of what I think has been implied here. There has to be political will. And so a part of that was to take a very close look at their own requirements and realize that they needed an upgrade, and then to change their own supervisory capability and upgrade it, and then to get into the nitty-gritty and say things like every payment has to have certain standard information, and oh, by the way, we are going to require a legal entity identifier. And then they've created are creating in the central bank an internal exchange of dollar accounts, almost like a clearing account for those who have dollar accounts. And then they engaged in a 3-year-long public-private dialogue with the major regulator in the U.S. that worked across the regulators, across society. And lo and behold, they came to the understanding that there was a privacy law in Mexico that was prohibiting the banks from providing some information to U.S. banks that was creating a lot of unease. Well, they changed that law. Now, on the other side, the U.S. agreed to provide information on Mexicans who are spending more than $1.5 million in cash on real estate in New York and more than $1 million in Miami, because this is not just one side or the other.
Yeah. Some of the other comments coming through talking about what are the alternatives. You just mentioned central banks getting more and more involved, and you, Richard, saying that they have to step their games up. Somebody saying U.S. banks clearing business act like a cartel. And, of course, somebody asking a question about Brexit. How will Brexit, when it actually does happen, affect any of this, or will it affect anything? Who wants to go with that? Anyone?
Well, as the English guy.
Yeah. Sorry, you got stuck with that.
I think it actually has no effect at all.
No, okay. No effect at all.
I mean, maybe I can go back to a point Richard made about the countries themselves and what they can do. I share your view, Richard. I think some countries haven't done enough. But I also am concerned that those countries aren't going to have banks reasonably in a similar position to my bank. Right? They don't have the capacity. They don't have the capability. They don't have the resources, and probably don't have the level of sophistication, if that's not too arrogant. I don't think we should. Well, I think we have to apply common standards to those countries. We have to recognize that the gap that they have between the standard and reality is quite large. But that shouldn't cause us automatically then to press the goodbye button. We've got to work with them to close that gap. And how do we do that? That's a really significant challenge. And how much time do we have to do that? I think we thought we had less time before. I think we now, with lots of common statements around we want to keep people in the system working with us rather than put them out of the system. But that gap is still quite significant in many countries. For me, I think it's the CDD that's the most critically important, as you said. My transaction monitoring can provide an extra protection. My screening can provide an extra protection. But I really need those banks to be strong on CDD, really strong, and then provide information to me if I need it in relation to specific transactions. So I do think that's where the big gap is. We certainly work with our correspondents who we believe are passionate about improving, to actually help them with capacity building to improve the entirety of their AML program. And that's our responsibility as banks too, with our network. But I do think I would like to see more from countries and regulators in countries enforcing the CDD standard.
Anyone wants to come back on anything so far?
Yeah, I would like to add one point when I look to the future, when I take the crystal ball.
Yes.
And I would say, well, we probably need a new business model for correspondent banking, providing simply point-to-point connection across borders, across currencies, will no longer earn a meal. It will be a commoditized business. Ripple will take care of that. Earthpole, who knows? Yeah, there are other companies out there, fintechs at large. So what is the value proposition of the banks? And I think John has made a point here by saying, yes, we are working with those willing to improve. Yes, we are providing, let's say, a better transparency. We are providing the better experience. I would say the better screening. Our product, therefore, is a payment that goes always through, whereas the others, when Ripple has to deal with anti-money laundering rules, yeah, they will have their work cut out. So far, they're using the banks, but this may come to an end, this type of business model.
Richard?
Yeah, John's point is correct about we do have to be concerned about the capacity of a large number of countries to implement the international standards. So we shouldn't be lax in those standards and in the way they are implemented, but on the other hand, we World Bank, the IMF, we are engaged in the assessment business. We assess the robustness of our members' anti-money laundering regimes. We deliver technical assistance upon request. We work not necessarily to solve or try to resolve any or the particular issue of the lost correspondent banking relationships, but we work to strengthen the basic systems that they do or must have in place in order to mitigate the risk of money laundering and terrorist financing in their jurisdiction.
And I'll just add that there's probably two types of countries, probably more, but FATF in 2013 said, how are you actually implementing those laws? And there are certainly places where you'll still see officials who talk about, well, we have the laws. Right. Are you implementing them? Have you actually held anyone to account for not following those laws? And I think you have to kind of sort through the jurisdictions to see that. The other part of that is that if you do have good laws and you have been implementing them, we've now learned that you need a little bit of PR and communication strategy, because there are countries that are doing the right thing and everybody thinks that they're not.
Yes.
And they're not aware of what the framework is. Jamaica falls into that, and other countries as well. So, we're all learning as we go here.
Sure. Somebody asking, do banks, in fact, have the social responsibility to address unintended consequences? Should that even be their job? Somebody else asking, if a representative office in a low-risk area is banking clients on behalf of the high-risk area, does this mitigate some of the risk? Who wants to take that one?
Well, rep officers aren't allowed to bank anyway. They don't have a license.
But the approach as such is valid. If, let's say, a large banking group from an emerging market, let's say, probably has enough financial muscle to set up not a representative office, but rather a subsidiary or a branch in, let's say, anywhere in the euro area, anywhere in, let's say, in North America, and then you could use that because there is, let's say, a kind of a seal of approval or guarantee, because this branch, this subsidiary will act according to the standards, to the law and the custom and the market practice of their, let's say, new home jurisdiction, and this should help.
Although that's changed a lot, Jochen, hasn't it? I mean, it used to be the case that within the EU area, all banks were considered low risk. That certainly isn't the position, I think, taken by most banks, even though that's the law. And certainly outside of Europe, that wouldn't be seen as acceptable, that Germany is the same as Bulgaria, for example.
But what about a Bulgarian bank in Germany? How would you rate that one?
I think that rate's higher than a Bulgarian bank in Bulgaria.
That was my point.
But not that much.
So you're talking about commoditization of the business. I mean, some people might argue because you've got less players, it could drive prices up. What would you think about that?
The price elasticity, I think, is not so high. It's more, I think, a cost game than a price game.
Okay.
And it's somebody said from the audience, who was that? 80% of the cost is fixed. Yes. That's right. And therefore, it's a kind of, once you have made the investment to be able to safely do correspondent banking, you can do a little more. You have already paid for it.
So somebody, earlier today when we were chatting amongst ourselves, somebody was saying blockchain is the new big word, isn't it? So we were saying that we should have the blockchain jar instead of the swear jar because everybody is using blockchain. And somebody asking, is blockchain going to help or is it just a distraction? Who wants to take that one?
So somebody at the last session, I think, or on Sibos TV today said something like, it's going to be 5 years before anything to do with the blockchain has had a meaningful impact, not just a small impact on anything to do with financial architecture. And I think that it is one of those things that can never live up to the hype, given how much it has been hyped. But the comment about costs, whether it's a distributed ledger or whether it's some of the things that Swift is talking about, or technology is going to end up being a part of how to manage the flow of information, costs, etc. But the underlying value of the blockchain is the validation of the information, and it's a little bit hard to see right now although I'm sure there will be a solution, but how across a disparate group of financial institutions you get that level of validation into the blockchain in a way that's sustainable.
Jochen, I know you have some very strong views on technology being used here. Tell us what they are.
I would venture, let's say, a prognosis like this. If we keep the anti-money laundering rules and the CFT rules as they are, blockchain will not make a difference.
Yep.
Okay.
In order to make blockchain a difference, to make it a difference, we will have to think of new rules or new application of those rules.
And what kind of direction would you like people to start moving in?
If you think of a utility, and if this utility gets being used by many, and if such a utility would get some stamp of regulatory approval, and if you then say, well, it's not necessarily blockchain, but distributed ledger will do, and you put such a utility in the middle, it starts looking like an interesting model. However, we are not yet even close. We are not there.
I agree really with that point. I saw a paper from a very well-respected institution that talked about saving 3 to 5 billion on blockchain for CDD. And then the proviso at the end said essentially what Jochen's just said, provided you change the laws and regulations that currently apply, which frankly is not going to happen anytime soon. So it's a really good point. However, if it were true that it would save 3 to 5 billion, we ought to probably think about whether or not those laws and regulations ought to be reconsidered. But we should do that anyway, irrespective of blockchain.
You raise an interesting point, Jochen, with where you think the conversation should be moving. I mean, will we at any stage then have a turnaround from the regulator where they will be willing to endorse a utility?
Not in the near future, but I could envision that, let's say, there's a gray area between, let's say, saying this is not of our business. Let's say you do the de-risking and you better do it right. And let's say we are silent on how you do it towards a stamp of approval. There's a gray area in between. So maybe regulators could be a little bit more precise in their, let's say, expectations, how one would use such a KYC utility, or if you outsource your, let's say, due diligence process, what are the conditions for safely outsourcing this, for, let's say, giving regulatory approval, not to the result, but at least to the process. This is something I could see we could engage in a discussion with the industry, and a positive outcome, not impossible. But even this is a long shot, I would say. Unfortunately, it is.
Is there a feeling, I mean, you meet with regulators, is there a feeling when we first started going down this road that the regulator would sit there and they'd say, go solve this problem, and it's almost like they wanted the banks to come with the ideas for them? Or was it the other way around, where they give you a prescription, as it were? I doubt that's the case. It's more sort of you go think about it and come back and let's see how we can do this together. Or is it just go think about it and we've got a zero tolerance for this and figure it out, get it done? What's your view?
The regulator is, he's the regulator of banks. He is worried that cross-border activity, or she, absolutely, actually, very often, they are concerned that international correspondent banking, which probably transfers 20% of the total process of crime on the globe, goes via the major clearing centres. That's probably the case. So they have an absolute right to be concerned with the movement of those funds and protecting of that. So they ask us to do our very, very best to interdict, prevent, detect and report in relation to those. I think that's a perfectly legitimate starting point. How we go about doing that is a dialogue. And best practices, and they evolve all the time because the nature of the threat evolves all the time. So it's not as though you can ever stop. This is the challenge that we have in this particular world. It's not as though we can just have a utility that never changes, because we're going to need to ask some more things when we understand the risk a little bit better. But I think that there is this recognition that I think that we do need to come together and have a much closer understanding of what those standards and expectations are, and then I think we can manage the risk much better.
Yeah, recently, I don't know, I think about 12 members of Congress sent a letter to the Office of the Comptroller of the Currency because they felt that the administration itself was sending conflicting messages to the banks. If you have, on the one hand, a Department of Justice saying people can be held personally liable, and you have what is bank regulation? But a lot of regulators and investigators and people who do the supervision going out into the banks. Mm-hmm. And so there was definitely a sense that different people were saying different things to institutions, while at the level of the institution, they were saying, we never tell a bank what action to take. Mm-hmm. And I think that's a piece of this, too, is that every system is made up of individuals. What are those individuals actually conveying? And therefore, what are the expectations that people are playing to? Mm-hmm. And there has to be clear statements from the top so that you know what the system is trying to do.
Mm-hmm. You want to come back, Richard, on any of those points?
No, I absolutely agree about the expectations and the clarification of them. One of the major areas, though, that I still think will require a lot of thinking, a lot of work on, is this whole area of the beneficial ownership of accounts, which is critical to knowing your customer, and knowing your and this is one area where I think that it's not only as far-flung jurisdictions that are having difficulty in implementing this, but it is also the major players around the FATF table that are having difficulty in trying to come to grips with that. I look forward to seeing how the implementation of the fourth anti-money laundering directive in Europe pans out, because there is a requirement for registering this kind of information, but that information is only as good as the people who put it in, and it's only as good as the story they're being told.
So the theme that keeps coming out here is you can have rules, you can have technology, but at the end of the day, it's all down to people, what people expect, what people communicate, what people understand that they're expected to do, etc. 5 minutes left. I'm going to ask each of you to tell all the delegates here when they go back into their offices next week, based on the discussions that we've had here today, how to safely bank low-risk clients in high-risk jurisdictions, and is it time now to re-risk? What do you want them to understand and do, actions to take, or actions you'll be taking when you go back to the office? Let's start with you.
Wow, that's a hell of a question. Okay. For me, my biggest concern right now is we think de-risking is slowing, but the thinness of the protection is much less than it was. I also think de-risking is changing materially from full exits to restrictions on product, and also restrictions in relation to the clients of the correspondent. So, for example, the MSBs of my correspondent, please don't wire their payments through me. Your charities, please don't, but you can do all your commercial business. That, I think, is the next iteration of de-risking, hidden de-risking within that space. You won't see it quite so easily, but it's there. It'll come out the other end. So that is of major concern. What we continue to do is to improve ourselves, really work hard to make ourselves better, really work hard with our correspondents who want to work with us to improve by capacity building, and really work hard with the regulators to set a standard that is achievable, realistic, but also we can publicly attest to, and we know where the bar is, and we all work towards achieving that bar.
Okay, Julie?
So from our perspective, it's working with those remaining high-risk jurisdictions to not be high-risk jurisdictions. Panama got blacklisted in 2014. By 2015, we worked together with the IMF on really broad legislation that brought in everything from lawyers to their diamond exchange to car dealers, everybody, right? And so that's really, I think, you got to get the high-risk jurisdictions to not be them. The thing that worries me the most, I think, is what John just said about the hidden de-risking and the thought that the system really needs to think about the money service businesses, because it's the only way to reach really poor people in really far-flung locations. And our answer as a system can't be well, we just can't figure that out. So given who's in the audience and who's on the panel, I think we have to put some more brain power into how do we address that.
Sure.
I'm glad to hear what John has to say about dialogue a little earlier on. I think the dialogue between correspondents and the respondents that are at risk, I think, needs to take place and needs to be looked at carefully. In other words, it has to be a thoughtful conversation and not just one that says that you're going to be cut off in 3 months if nothing happens. The other thing that has to happen as well is that, I do think this, is that that countries themselves have got to take a close look at what they have in place, how they actually implement it, not just what they have on the books in terms of laws and regulations and institutions, but how they actually implement it. And is it delivering the results they need, as well as the international community needs?
Mm-hmm. And Jochen?
Yeah. I would like to chime in this, let's say, need for dialogue, but with a little twist. I would like the compliance officers and the business managers to have the same dialogue as we have up here, back at home in their institutions. And yes, you can bank good customers in high-risk jurisdictions. You can do this with an extra dose of due diligence, a strong dose. But yes, you can, even if this is difficult for a compliance officer to comprehend. I know it's difficult, but yes, you can.
Okay, well, thanks to all of you for joining us. Let's give them a warm round of applause, everybody. Great discussion.